Here we are talking about the markets. We're seeing this trend of recovery across equity markets. This is happening after that major downturn over the past few days. Despite that, though, of course, the Nifty has lost more than 300 points from the day's high today, and we've ended in the red. Yes, marginally, but even then, about a quarter of a percentage point cut at the end of today's session. The insurance players like HDFC Life, like SBI Life, those were the top losers in trade today. And if you look at the sectoral play, there was public sector banks. Those stocks were the top losers. Auto stocks were on the slide as well, and banking stocks were trending down. But on the other hand, you had realty, IT, and metal stocks, which were holding fort and advancing in trade today. Let's get a perspective on the markets and how we should be aligning our portfolios in times where volatility is the name of the game. Mayuresh Joshi is head of equity at Marketsmithindia. Mayuresh, always a pleasure having you on the show. If I could ask you to rank the kind of factors that are at play, one being the most important ones at play, which will help us align what we need to do with our portfolio in such volatile conditions. What would those factors be, Mayuresh?
Evening, Vikram. So I think to broadly list down the factors, three of them specifically. First, obviously, the yen carry trade, which has created a huge amount of upheaval into global equities, emerging currencies as well. And therefore, the kind of reactions that we saw over the past couple of days is a testimony to the fact that the lower borrowing scenario or borrowing at absolutely zero rates is done and dusted with. And therefore, the unwinding of aspect obviously is how the US economy is expected to fare. There have been mixed economic data points as far as the US markets are concerned. And therefore, how these data points shape up in the next few months, next few quarters, is going to be extremely critical to see the perspective whether we are actually going to see a hard landing recession in the US or it's going to be a soft blow to the US economy in general. And third, obviously, is the geopolitical angle. What happens within the Middle East, specifically in terms of Israel, Iran, Hezbollah, and the repercussions thereof in terms of the geopolitical ripple effects that might take place. That is something which has rattled the global markets at this juncture. But as we get some element of resolution on all these three factors, I think there will be some amount of sanity returning back to us.
Do you think it's time to look at your portfolio and say that perhaps we need to do a bit of a rejig, considering that things are changing? If you look at the US economy, whether it is a hard landing or a little less than hard landing, is that something to keep in mind at this stage? Looking at the cues that the RBI would take, looking at all the global factors, even the geopolitical concerns right now, apart from our domestic factors, which is food inflation, how do you factor all of that in deciding whether or not your portfolio is aligned to what is to come?
No, absolutely, very valid point. And to that perspective, Vikram, I think what really transpires within the Indian economy is going to be extremely critical as far as the macros and the micros are concerned. So the expectations in terms of a steady state GDP growth is expected to take place over the next few years. Against that backdrop, corporate earnings are expected to grow at a decent pace in the next few years as well. So I think both macros and micros should largely align for the Indian economy. All the other factors that we're speaking about, I think they will have effects in terms of how global markets move. But domestic liquidity has remained extremely strong at this juncture. And the expectations in terms of SIPs expected to continue at the pace at which they are, and even compound at a reasonable pace over the next few years, will mean domestic liquidity will counter the FII flows as we have been seeing over the past few months and past few quarters. And therefore, I think earnings is something that the markets will wholly and squarely look at. A base case scenario for 12 to 14% earnings growth on a CAGR basis over the next 2 years is something that the market is penciling in, and therefore the premium valuations for India. So I think India does stand out, Vikram, in terms of how we are positioned vis-a-vis the globe.
Considering the earnings reports that we've seen, and of course that needs to be factored in as well, how the corporates are positioned themselves to take on the challenges of the future. In that sense, you want to factor in which sectors will remain largely insulated from the kind of volatility that we are currently experiencing. Which are the corporates, which are the sectors that you think are doing this best right now?
So to a large extent, domestic cyclicals, Vikram, will continue doing well. So the kind of capex that the government has announced in key areas as far as infrastructure stroke manufacturing is concerned, selective plays are expected to continue doing well. So waste and water management as a theme will continue doing well. You are expected to see manufacturing gain a lot of traction going forward as well. And therefore, I think as a proxy play, cement companies as an example, a few of the infra companies might continue doing well as far as earnings growth is concerned. Uh, in terms of banks itself, I think to lend support in terms of the financial viability for a lot of sectors at play, banks will come back in focus. Yes, they have been witnessing a lot of deposit-related issues at this juncture. But as things normalize as we head into the second half or the next year as well, banks and BFS as a space will continue doing well, in my opinion. Last but not the least, consumption, which is a very broad-based theme, but select pockets within consumption will continue doing well, specifically discretionary consumption. Good monsoons will mean rural economy will bounce back very, very sharply. And therefore, a lot of factors at play as far as discretionary consumption is concerned, followed by the durable consumption. I think consumption as a theme will also be a big play as far as Indian markets are concerned.
What do you do with your IT stocks right now? Because, yes, we've seen them come through difficult times. Whether we look at recessionary times, we see what happened in COVID as well. The big hit was on IT companies, but they have bounced back. Is that expected? And should one look at getting rid of some of the IT names in one's portfolio, or keep holding?
You can keep holding because I think it becomes a perfect hedge in volatile times like these. So I think IT and FMCG are the perfect hedge for volatile markets. Again, I think a large broad-based expectation, Vikram, is a second half recovery in terms of how expectations are being laid out, specifically in terms of BFSI, retail, manufacturing. These are the three key segments that the IT companies cater to. And the two biggest geographies, North America and Europe, should show signs of stability and recovery as well. So to that extent, large cap IT companies which have been facing issues in terms of large multi-million, billion order wins deals, stability in terms of the order wins itself, expectations of maintenance of the EBIT performance, and last but not the least, in terms of consistency that one needs to show in terms of both hiring, utilization, and bottom line growth. So I think there will be a gradual recovery as we head into the second half. Mid-cap IT companies have been outliers on all these parameters that I discussed. They have been ranked, showing a ranked amount of superiority as far as earnings pedigree is concerned. But valuations have become a tad bit too rich and late-stage basis as we see it in Marketsmithindia. So you can continue holding IT stocks, but large-cap IT will see a recovery post-second.
What do you expect? The Japanese Prime Minister, of course, has allayed concerns about the Japanese economy, and part of the factors which we were discussing yesterday was about the yen carry trade. Is a lot being made of it? Do you think there's something to worry about there?
No, I think institutions across the globe, Vikram, very honestly, were used to getting absolutely cheap money at zero interest rates at this juncture. So as the carry trade unwinds, obviously the repayment schedules and the appreciation that we're probably seeing in the yen at this juncture is going to create some amount of upheaval. But unless there is a significant amount of hike in terms of the rates itself, in terms of quantitative tightening, as we see, the three controls that they probably have as a bank, as a Japanese central bank, are overnight rates. They've obviously got the yield cost curve control, and obviously quantitative tightening or easing. So I think if they go too fast, the issue will become in terms of the long-dated securities having a steeper curve, which will become a little bit more difficult for the banks themselves. So in my opinion, I think the markets are bracing a little bit ahead of themselves. The Japanese central bank, in my opinion, will take a calibrated approach, which should suit the nerves over the next few months.
Do you think the Fed is going to take a calibrated approach, or do you think this kind of drop in growth is going to spur them into quick back-to-back kind of rate cuts? And if that pace hastens, are we likely to see, where do you expect the interest rates to settle in the US?
So largely, I think as I've been speaking to my US team as well, the expectation is that you're getting mixed data points as far as key economic indicators are concerned. But having said that, the expectation largely is will the Fed governor wait for inflation to come down to 2%, assuming that economic conditions worsen up in some parameters as we are witnessing at this juncture, or he starts with the rate cut cycle. I think the consensus now is a September rate cut on the cards. And therefore 50 pips not ruled out before the end of the calendar year. So let's see how it works.
Several factors at play, but meantime, we're looking at how the US economy is likely to do. For the most part, you must have digested the macro data that came through. What's the sense that you're getting? Because Indian companies have so much exposure to the US markets as well. In that sense, how do you expect the American economy to do? If you could elaborate on whether or not that hard landing, that less than hard landing, where do you expect that to be?
So very honestly, Vikram, very difficult to gauge what will happen over the next few quarters. But the data points that we're getting at this juncture would indicate that there would not be a hard landing as far as the US economy is concerned. Yes, there are pockets of concern, and the jobless claims are going up more than expected in the last reading. You're seeing some element of manufacturing slowdown happening. We are getting reports in terms of a lot of savings now getting utilized at this juncture. But I think there is some element of pockets of strength as well. Consumption is still very much normalized in the US market. There are some pockets as far as the real estate or the mortgage market is concerned, which still remain overheated. But to that extent, again, I think as things normalize and as the base case scenario starts kicking in, if rate cuts do start coming through and spur consumption, demand, and spending back into the US economy, I think there will be some element of earnings recovery that companies that are based out of the US can also report outside the platform companies, specifically manufacturing and retail as well. So that's the hope. And therefore, I think staying on the middle path, assuming not a hard landing, not an easy path as well, but somewhere in the middle.
Well, at this point in time, the recovery is being seen on Wall Street after the drastic sell-off yesterday, and we'll see exactly where they end today's session. But Mayuresh, such a pleasure having you on India Tonight with your perspective. Thanks very much for joining us.